Hello, traders. If you've been looking for a simple yet effective trading strategy that works in Forex, crypto, and even stocks, then this video is for you. Today, we'll cover a powerful strategy based on moving averages that helps you identify strong entry and exit points, avoid unnecessary losses, and maximize your profits. Stay tuned until the end because I'll share some golden tips that most traders don't know. Before we dive into the strategy, let's first understand what a moving average, MA, is and why it's so useful in trading. A moving average is a technical indicator that helps smooth out price action and identify the overall trend. When the price is above the moving average, it indicates an uptrend, and when it's below the moving average, it signals a downtrend. But most importantly, when two moving averages cross each other, they generate powerful buy and sell signals. This crossover concept is the foundation of our strategy. Now, let's set up the strategy on the chart. To use this strategy, we need two moving averages. A fast-moving average, 9-period MA. A slow-moving average, 21-period MA. You can apply these settings on any trading platform like TradingView, MetaTrader 4 and 5, or Binance. Now, let's see how these two lines work together to generate trading signals. Now, let's go over the main rules of this strategy. 1. The first law: moving average crossovers. Buy signal. When the 9-period MA crosses above the 21-period MA, it indicates an uptrend is forming, and we should enter a buy, long, trade. Sell signal. When the 9-period MA crosses below the 21-period MA, it signals a downtrend, and we should enter a sell short trade. As you can see, when the blue MA, 9, crossed above the red MA, 21, the price started moving upward, making it a great buy opportunity. The second law: avoid trading when price is too far from moving averages. Many traders focus only on moving average crossovers but ignore a crucial rule. If the price is too far away from the moving averages, a pullback or reversal is likely. So, you should never enter a trade when the price is too extended, as it might be a market top or bottom. Now that we know when to enter trades, let's talk about risk management, one of the most critical aspects of trading. Stop loss (SL). In buy trades, set your stop loss below the recent support level. In sell trades, place your stop loss above the recent resistance level. Take profit (TP). Use a 1-to-2 risk-to-reward ratio. For example, if your stop loss is 50 pips, aim for a 100 pip profit. Alternatively, exit when the moving averages give a reversal crossover. Now, here are some advanced tips to make this strategy even more effective. Use RSI for confirmation. If RSI is above 70, the market is overbought, meaning a pullback is likely. So, avoid buying at extreme levels. Works better on higher timeframes. This strategy performs best on 1-hour and 4-hour timeframes, where there's less market noise. Always follow proper risk management. No strategy is 100% accurate, so always use stop losses and manage your capital wisely. Alright, let's summarize what we've learned today. This strategy uses two moving averages, 9 and 21. When the 9-period MA crosses the 21-period MA, we enter a trade. Avoid trades when the price is too far from the moving averages. Use stop loss and take profit wisely to manage risk. This is a simple yet highly effective strategy, but always backtest it on a demo account before using it with real money. If you enjoyed this video, make sure to like, subscribe, and drop a comment below. What trading strategy do you use? Let me know, and stay tuned for more videos.